And welcome back to the MedTech Wealth Advisor Show. Thanks for joining us. I'm your host, Matt Nelson. I've been managing partner here and senior financial advisor with Perspective 6 Group for many years now. This is the only show dedicated to helping professionals working in the MedTech field plan for retirement. And, our goal is just to educate the MedTech community about planning and investment-related topics. And, of course, while we focus on topics relevant to those in the field, we're working with clients from all over many industries planning their retirement. Joined today again by Jacob LaRue, head of financial planning here at the firm. Jacob, how are you?
I'm doing good.
Last time we talked, I think you were jumping in a car and heading on a family vacation. Apparently you survived.
Yeah, we did survive somehow with 2 kids in the car for 12 hours there, 12 hours back. It was a good trip, but a long one for sure.
No breakdowns in the back seat.
Yeah, there was a
Couple.
Yeah,
Emotional
just
break.
a couple, but screen time kind of helped that.
Yes, of course. Well, I'm glad you made it. Glad you're refreshed and back at it. I'm actually, I'm headed off to a race weekend up in Marquette, Michigan here, leaving tomorrow. And, that should be fun. We do a lot of mountain bike racing, of course, as people have listened to the show before. And this should be a big one. I don't know if I'm prepped enough for it, but it's a 48 miler. If I can get in under 3 hours, I'll be happy, but we'll see. I'm getting old.
How you'll get there. You're not quite 50 yet.
Yeah, right. Well, so today we wanted to focus on something we haven't talked about much in the past, and super fun topic. I'm sure it's the first one on everyone's mind. How much life insurance do I need? And of course, I say that in jest. No one wants to talk about that. But it is important. We've got to cover it, and it comes up in all of our financial planning process. We've gone over the planning process with you on other shows, and at some point you need to think about, how do I protect the plans that I have in place? How do I protect survivors? This question comes up. In fact, when we were prepping for the show, we started entering into Google, how much life and the pre-filled insurance do I need? So hence the title of the show.
Exactly. Yep. Good old Google.
Yeah, that's right. So we're going to cover today how to think about this, the purpose of the coverage. How much life insurance do I need? Of course, it's like, well, what are you buying it for? Then how do you go about determining the amount? Because there's different frameworks to use. And then once you've determined that, you got to decide how to buy it. What do you use? Lots of different ways. So that's the big framework for the show. And let's just kind of jump in and get at it. So, purpose of the coverage. I mean, we always start with a goal in mind. You could just buy a big chunk that sounds about right, which is probably not the best way to go about it. Or, just think about the different reasons you're looking for. It could be to support survivors. That's obviously the biggest one. Take care of family, take care of that, that wife and kids you have, Jacob, so that they can keep going on vacations should you come to an early demise. That's
exactly.
Debt obligations, obviously. Final expenses could just be that you're looking for a burial policy, some people call it. There could be a big major life event, and that's what's prompted this question. Maybe you just got married, or maybe you just got divorced. Both of those reasons can actually prompt you to kind of look at needing some life insurance coverage. And then a big one that comes up with many of our retired clients, it moves from all these other supporting survivors to more of an estate planning and kind of taxation question. Working through a couple of cases right now where it's a very significant part of the planning to help protect some of the inheritance and offset some huge debts that would be there because there wouldn't be enough liquidity if someone passed away early.
Exactly. Yeah. Estate tax can eat away at those assets pretty quickly.
Right.
But yeah, all those things, just like everything we do, it's kind of funny to see. It really depends on that client and their situation, what they're looking for. Some people really want to pay off their mortgage. Others, hey, that's just an expense.
Yes.
So there's a range of outcomes.
Exactly. So thinking about the purpose and, and actually that when we talk about this, that how to determine the coverage amount, we've got 3 different frameworks we like to go through. One we're more preferential toward, but there's 3 big frameworks. And it kind of the purpose of the coverage and the frameworks tie together. So let's just look at how do you figure out the amount you need. We think of things in 2 major frameworks. We call a human life approach, and then there's also a financial needs analysis approach. Now, a very common rule of thumb framework we'll use first, which we don't actually use in our planning, is just a multiple of income. So, start there because I know you've heard that before and you've had clients ask you that.
Exactly. That's probably the most simplest version of coverage if we're just looking at replacing somebody's income. You just take, hey, how many years do I have left to work? What's my salary? Maybe assign it an inflation rate or kind of what you get in a raise year to year. And then you just multiply it over those working years. So let's say you're 10 years from retirement, you get 10 times your income. That's bare bones is what we like to call that.
Yep.
Because there's just so much more that goes into that actual value when you're talking about your life and your heirs' lives. So
that's right. Default option, better than not having any other way to determine. But moving into a little bit more sophisticated way to think about it is the title isn't really the best. Like the human life approach, it's just sort of, it's a very old, way to think about it, the titling of it, but it's kind of accurate, and so what this approach does is we're trying to estimate what is the current value, so the present value of a person's estimated future earnings. Okay. So this approach, doesn't add up like the next approach, all of the needs, all your mortgages and those sort of things. This is purely focused on what are we missing out on if someone passes away and they have no salary.
Exactly. Yep. That's a great way to put it. We're not adding anything on there, but we are giving it some type of discount to today's present value, like you said. Because theoretically, hopefully if you have $1 million life insurance policy that pays out, you're not just going to sit on cash at a bank that's earning nothing.
Yes.
We gotta assume some type of interest rate or investment rate of return if those proceeds get invested. So that's how we come up with the value from there.
Right. And, if you think about it this way, if there's, let's just say there's a couple, make this easy, couple and they have a couple children, both of the spouses work, and the plan is that one of the spouses is going to, that they're each going to work another 20 years. Let's just use that as an example. And, now you can estimate how much would their salary earn them over the next 20 years. Using inflation offsets and some other factors like you mentioned, we can figure out an approximate amount. How much is that salary worth today? And if you think of it that way, had the person not passed away, their salary would have been used to do all of the saving, debt payments, emergency funding, education, school funding, all of that would have been paid out of salary. So all we're doing is saying, we're not trying to make the survivor, any richer, so to speak. We're just trying to replace what income they had planned on anyway, and then that would go to fund all of these other measures.
Exactly. It's a good way to maintain that surviving spouse's current lifestyle, so they don't have to sell the house just to make things work, or buy very unhealthy food just to make their budget work. So
absolutely. So let's just move on then to like the approach that really is more like adding everything up. we call this a financial needs analysis. Now, this analysis, instead of just estimating the future value of earnings, this analysis is a little more complex because we now have to have a full financial plan prepared, really to do it correctly. Because what this approach is going to do is it's going to take, in prior shows, we talked about, well, how do we plan for financial independence? How do we plan for time off, sabbaticals, the goals? How much do you want to pay for your kids' college? All of these items can get dumped into a timeline and a projection. And then we can look at what is the total cost of all these goals and come up with the insurance need that way. That's do you see how that's almost the reverse of the human life value? It doesn't care about the goals as much as just simply replacing income.
Exactly. Yep. It's taking this approach, the financial needs analysis, like you just said, it's taking your income needs and then adding in all of these other variable expenses that you might have fall on or off at different times throughout your independence plan. And we've seen things like you said, college expenses, all the way to student loans that are in the $300,000-$400,000 range for some doctors, and there's just different goals for everybody, and that's why these types of analysis, we like to do them this way, because it lets us dig into what's important to that person.
Yeah, it gets more custom. It's more custom because, we have a reasonable or a realistic, I should say, conversation with a client. No one wants to think about their spouse passing away, but we want to just set them up for that scenario. Okay, Joe and Sally, if one of you passes away and we're sitting here still with Joe, how would you want Joe's lifestyle to look, and vice versa, right? I mean, it's not that we're trying to make one of them richer or poorer if they pass away, but what would we want to have replaced? Now, the custom part would be maybe one of them says, you know what, if I'm single, I'm not going to live in the same house. So how much would I need to just pay off the mortgage and then be able to afford a downsized house? Not because I have to, but because I literally wouldn't want this large house to live in. Well, that's a very custom kind of look at things. Okay. Also, what if one of us dies first? The other one hasn't been working full time, and they don't want to have to be forced to work full time. Well, that could be something we want to put in, or vice versa. It's, I have been working part time. If my spouse is gone, I'm not going to want to sit around the house. I'm going to want to work full time. That changes the equation as well. So it's just a much more custom way to get an accurate approach of how much coverage you need.
Yeah, very, very much so. Accuracy is important.
What's the process you take? And I know I kind of alluded to it a little bit, but is there anything you wanted to add to our process specifically?
No, yeah, I think the most important thing there is kind of what you were saying is everybody's goals and objectives are different. So we take them through a series of questions and kind of show them, hey, this is what your income replacement would be. Now let's build on top of those things. Do you want to pay off the mortgage? Do you want to pay for your kids' school? Okay. How aggressive would you want to be with the proceeds of that insurance if we were to invest it?
Very good point.
Put some type of assumed growth rate to it. Because again, that's going to change that number and might drive it down where insurance is more cost effective for you. That's right. We take them through all those questions.
Yeah, that's a very good point. So, I mean, I guess to kind of wrap up this section, it's if you really want the easiest way to do it, just, do a multiple of income. Probably 10 times income is a minimum, I would say, to start. And maybe it's like a 10 to 15 times income is a reasonable place. The next method might be to just estimate your lifetime earnings. That gets a little more complicated. There's probably some calculators online you can figure out to, use to figure that out. A lot of pitfalls with that though. And then the most customized version really is just this needs analysis and kind of a combo of that. So I know there's the problem is, even as we're going through this, the question on the show title is, how much life insurance do I need? Well, it's a little tough to give you an exact rule of thumb. A lot of factors in it, but you'd be surprised you'd be surprised that it's a lot more than you think. And that's not because we're big fans of insurance. In fact, we do not want to use insurance whenever possible. If someone has enough capital saved up, love to avoid the insurance. But that's just not the reality as people are saving for retirement. They don't have the capital saved up yet. And so they have to have capital created to take care of some of these goals. So we want to use the least amount of insurance possible because it's expensive and you hope to never use it. But we have to have enough to make things work. So, yes.
Any plan, when we're planning a cash flow plan or independence plan, like we've talked about in the past, you have to protect what's yours. Just part of it. So even though it's not a fun conversation, it's a necessary conversation.
That's right. Okay. So we have a framework for at least to start with how to think about how much coverage to have. And now you have to fund it somehow. So you've got some different policy options. Before I jump into a couple of general categories of that, one thing I want to point out is we need to think about the coverage need, whether that's going to be temporary, whether it's going to decrease over time or increase over time. Usually coverage is not a 1 point in time, calculation and then you're done. There could be a need for a certain base amount of coverage, and you use a certain type of coverage type, maybe it's group insurance or personally owned insurance, to just cover the next like 2 or 3 years, and then you use a whole different type that covers the remaining 15. So so we have to answer that question first.
It's a great point. Yeah, I can think of a couple examples where, we've pointed it out to a client. Look, you only have 5 years left on your mortgage. Your group coverage through work actually covers that. Let's set aside that part of your insurance package to pay off that mortgage if something did happen to you today, and everything else is just going to be for future use or future needs.
Yes, that's a good example. So we already kind of alluded to the policy categories, if you will, generally fall into employer coverage. So what you can get through work, we refer to that as group coverage. And then you'd have personally owned policies. And within each of those, there's different types. So within the group coverage category, of course, first of all, it's really cost effective because your buying power is increased as being part of this group. That's the most attractive part about it. However, the least attractive part about group insurance coverage is it's not portable. You can't take it with you if you change jobs. So you work at a great company like Boston Sci, you get a good job offer somewhere else. Hopefully your health is the same and you can go get personally owned coverage, or the next employer has just as good a coverage that you can obtain.
Yeah, a very common example. I can think of a few clients actually that, might be working at these big companies, and we've talked about this in prior episodes, and then they want to go tackle a smaller company.
Yeah. And
smaller companies might not have as good benefits. So you're probably going to lose out on some coverage there.
That's absolutely right. Exactly. As an example, of the different types of group coverage, we were looking up what Medtronic offers in their package. And this is super common, kind of a setup for the bigger companies, but I wouldn't see these, just like you said, in the privates. So Medtronic offers at least as far as the last information we had, they offer a one-time annual base pay. So 1 times your annual base pay. So, if your salary's $200,000, basically they're providing $200,000 of coverage. And they'll let you add on another 1 to 15 times base pay if you're going to pay for it yourself. So you pay for it through payroll, but you can get up to as much as $4 million of coverage. And that's on just their kind of standard plan. So the first salary amount's covered, and then you can add on as much as you want up to $4 million. Now that makes it attractive because the first 200, or in this case, first salary amount's covered. But there's examples of people that need definitely beyond 4 million of coverage. Sounds like a huge number, but when we're talking about some of the incomes we see out there and the cases, you could need beyond that.
I think that's really good. And then, there's definitely some downside too in some of these companies because, a lot of them might say, hey, base salary, but they might not cover your bonuses or stock options that are vesting. And those are part of your cash flow that you get used to.
Right.
It's a big deal to consider.
That's a huge example, especially depending on how your comp is structured. It could maybe half of your comp is not technically covered in that baseline. So you're definitely going to need to add on additional. What's unique, what we saw in Medtronic, they offer a business travel accident policy. So, you could be part of the executive team or just a sales group where you're traveling all the time. And that could be really significant, but they'll pay for up to 6 times your base rate to 1.5 million. They also offer for you to buy an accidental death and dismemberment policy. Now, we were chatting before the show. Tell me your thoughts about that.
Yeah. Everybody, I think, thinks that it's awesome to have as much coverage through work as possible. But oftentimes, if you have a policy like that, AD&D, there's specific things that have to happen for you to actually collect those benefits if you're gone. So it's not always the best option. So you might feel like you have a lot of coverage, but it might not actually be real.
Right, exactly. So you might think, well, I got 1 times base pay. I've got all this, this travel-based insurance. I've got AD&D, accidental death and dismemberment. I've got plenty, but you have to die in the right way to get all the coverage. So when we're doing the planning, we like to think of those as just add-ons almost. Really need to have some your core need needs to be under the standard set of protection. And that brings us to using personally owned. So we've got the group policies and then we got the personally owned. And oftentimes you really want to look at owning some coverage yourself, just direct with a carrier. So it takes away that issue of if you change employers, you don't lose it. You actually also get to lock in the rate. That's something we didn't talk about up above, but group coverage often is really cheap. It appears the given year when you compare it to buying insurance on the marketplace, like with an individual company. But it increases either every year or every few years. There's some sort of graded scale that comes with your benefit package. And almost without fail, if you add up, 20 years worth of paying group coverage versus buying a 20-year policy originally, a term policy we're talking about, you're almost invariably going to save money by paying a little more at first to buy your own policy, but then you own it for the full 20.
Yep. Very common. We see that all the time. It's product of your age too when you're part of a group benefit pool. So
yeah, exactly. So now, and when I was talking about the personally owned, there's so many different types of insurance you could buy. There's term insurance, whole life insurance, there's variable life, universal, first to die, second to die. There's just all these different ways to do it. And really all we're talking about in this show is just pure coverage. What if you die? How do you take care of survivors? Fund retirement for your your spouse. Pay college tuition. Most people probably are looking at term insurance, the cheapest way to purchase it, and then maybe supplementing it with their group insurance plan.
Right. Yeah. Those examples that we were going through earlier when we were talking about financial needs analysis and working years, term coverage is more often than not what you'll hear us talking about during that time frame, during the accumulation phase. But as you're saying, there could be some other types of policies that make sense if other clients or yourself have objectives of passing on money to heirs or leaving something large to charity. That could be an option here too. So yeah, there's whole life policies. There's universal life policies that have a little cash value tied to it with an investment component. Yeah, you can talk about that more too.
Yes, I love how you used investment component in air quotes. That's
Exactly.
I'll try to not go off on a tirade, but insurance is called insurance. Insurance is not investment, so that may have to be a whole different show, because it's a high horse to get on. But yes, just for pure coverage. So beyond that, I mean, there's all kinds of, if you start going on the road yourself, listeners, of just looking into coverage, don't get too distracted with all of the miscellaneous riders that you could add on. These can really add up the cost. You'll see things like living benefits and accelerated benefits. There's disability waivers, long-term care riders. Many of them have value. Like, there's reasons why you may or may not want to add them. But don't get too distracted with it. Just focus on the core coverage first. And then if something includes a rider and that's the tiebreaker between costs, maybe it's $1 or $2 more a month, great. But at least with the core coverage, we're not going after adding on everything in the kitchen sink just to get your policy in place.
Yeah, just those added costs. If you're paying for a 20-year term policy, those riders can add up over those 20 years and it becomes a big part of your expenses and something you might actually not use or need during those 20 years. So,
yep, absolutely. Well, I think that kind of covers it. I mean, we really just wanted to talk about this in a framework of the question we get, like, well, how much life insurance do I need? Do I even need it? And I think the answer is for a lot more people than they realize. They do need some coverage, and they probably need a little more than they have. And if you just think about it as a needed cost, you insure your car, you insure your house. If you had a big pile of money already saved up, but you still have another 10 or 20 working years, well, your income is worth quite a bit. So you might want to insure your income, even if your survivors don't need it. So there's a lot of ways to think about it. There's no one answer. How much insurance coverage should you have? But if you need help looking at that or need a second opinion, let us know. We're happy to go through that with you.
Always. Yep.
Yep. So if you know anyone that needs guidance like this, let them know about the show. Happy to get more listeners. Let us know if you have any other topics for consideration or things that you want to go over. If you're a fan of the show, just subscribe. Just let us know you like it. Helps us out. And if you just want to learn more about the MedTech Wealth Advisor team, visit our website at perspective6group.com, or you can call us directly at 952-225-0343. If you have any questions or comments about the show, you can email the show at mwapodcast@focusfinancial.com. And that's it. So until next time, this wouldn't be possible without you, the MedTech community. Just remember that financial freedom takes a lot more than money. So find your purpose, make a plan to live your life well. If you need any guidance, we're here for you. Take care of yourself out there.